Hi, everybody.
Good morning, everyone. My name is Robin, and this is Alex, and we are with Ironwood Financial. Today, we're going to talk about something that is very common for someone to ask us when they come in, and that is, how do I take money from my portfolio? How do I spend my money?
Great question. I mean, once again, why did we save all this money in the first place? It's so we could spend it and enjoy it. But the number one fear that retirees have is not outliving your money. So we need to do this in the right way. Back in the old days, when I started in this industry in the late 90s, we found that the best way to do it was simply living off interest. Okay, if you remember, interest rates were much higher than they are today, and you could get an 8% bond and simply take, let's say, half of your portfolio, put it in those bonds, and then live off the interest. And then you take the other half of your portfolio, put it in the stock market, and that could grow for inflation protection and future needs. Unfortunately, in today's interest rate environment, you can't do that anymore. You need to have ridiculous amounts of money in order to get enough interest simply to live on.
That's right, Alex. I think I was just looking at the 10-year Treasury bond is paying something close to 2%.
Yeah.
That's going to make it incredibly hard for us to live off the interest.
So all you need to do is just double the amount of your retirement savings before you retire.
That's right.
Or actually, in this case, quadruple it if we're trying to get to that 8% number. So if your goal was 1 million, simply make the goal 4 million and retire later.
That's right.
That's one method.
Yes.
Okay, so interest rates are too low, so you can't use the old method anymore. So what do? So instead, you have to get a little more creative. The challenge is, the only investment that seems to be paying decent amounts of return these days is the stock market or risk investments. Okay? And obviously, risk investments carry risk. So what you need to look at is volatility. Robin, do you want to go over that?
Volatility?
Robin doesn't want to go over it. I'll do it. Here's the problem with investing in the stock market for a distribution stream or for an income stream. Every year, you don't know what the market's going to do. The market has a volatility range like this. Okay? We've seen negative 60 in 1 year back in 2008. We've seen positive 40 in 1 year. How can you plan your income based on that? How do you sell at the right time? Well, what you need to do is you need to invest like somebody who's 20 years younger. So quite simply, you need to buy yourself time. So as an example, if the stock market can do this over 1 year, let's say this number is positive 40. What are the chances it averages positive 40 over 5 years? It's never happened, probably won't. So by definition, when you give it 5 years, your range shrinks, okay? So your range might be something like negative 10 to positive 15. Well, that may still be too high. So what if we gave it 10 years? What are the chances the market averages negative 10 over 10 years? Well, it's never done it,
no.
And it probably won't. So instead, the range shrinks down. Now suddenly, we have a palatable range. It's something that we can plan on. Maybe that range is positive 5 to positive 15, or positive 3 to positive 15, something like that. By buying time, we now can open ourselves up to being able to invest in the stock market.
That's right. Now, so Alex, are you saying that we need to put all of our money into the stock market?
Absolutely not. What I'm trying to show you, though, is that there's a way to make the stock market an appropriate investment for people who are retired. Okay? A lot of people, when they retire, all their friends tell them, or they hear at work, what is it everyone tells you?
I have no idea what you're talking about.
Everybody gets this advice when they retire from their friends, their coworkers. Now that you're retiring, you need to take your money out of the market and put it in something safe.
That's right.
Okay, that's simply not true. What you need to do is you need to make sure you have enough money in something safe to weather the stock market volatility. There's a good strategy to do this, and what we do is we simply break your money up into 3 different piles. Okay, pile number 1 is the money you're going to be spending in the next 5 years. And what do we do with that money? We put it into something very safe.
Safe things like, it could be simple as cash, it could be treasuries, short-term bonds.
Absolutely right.
Bonds.
If you're going to use bonds, you're going to want to use bonds that have a fixed maturity date, though. So you don't want to buy a 30-year bond for a need that happens in 2 years.
Good point.
So, as an example, let's say we wanted to spend $100,000 a year. Over the next 5 years, you're going to spend $500,000. Well, in this strategy, what you do is you take about $480,000 or so. You do have to do the math, obviously, But you take about $480,000 and put it into a series of short-term bonds. A 1-year bond, a 2-year bond, a 3-year bond, a 4-year bond, and you leave about $100,000 in short-term accessible cash like equivalents. What you do then is you spend that first $100,000 in year 1. Meanwhile, the other 4 piles of money are growing. And then in year 2, you spend the second one, year 3, you spend the third, so on and so forth. Over the 5 years, the interest will have made it up to that $500,000, and you will have spent the entire first pile of $500,000.
That's right. But now again, we still have 2 other piles that we haven't touched.
That's right. And those piles have grown. And more importantly, those piles have had 5 years to do their thing. So pile 2, again, we talked about the stock market, 1-year volatility, 5-year volatility. There's still some range there. So what we're going to do in pile number 2 is we're going to invest not entirely in the stock market, but something maybe, a moderate portfolio, something with some risk, but not nearly as much as a full stock portfolio. Given 5 years, this portfolio should grow because over time, the stock market historically doesn't tend to go down over a 5-year period.
That's right.
So we start all 3 of these piles at the same time. So on day 1, the same time we funded that first pile of money, we fund the second pile of money. In the second pile of money, we maybe need to put $400,000 in, for example. Remember, it's got 5 years to grow up to that $500,000 number, which we'll then spend over the next 5 years, or years 6 through 10 of our example. So remember, by the time 10 years have passed, you've completely spent pile number 1, you've completely spent pile number 2. But that whole time, pile number 3 has been growing.
That's right. It's had 10 years to grow. And as Alex just mentioned, that volatility over a 10-year period has gone way down.
That's right. So if you look at the market over a 10-year period, chances are that's going to be up, and it's going to be up significantly. However, we still, just because of the sleep well at night factor, don't recommend people go an all-stock portfolio in that third pile of money. So we might do something, between moderate, maybe even a moderately aggressive portfolio for those people who can stomach it. So we're starting with a $2 million portfolio. We spent $500,000 in the first 5 years. We spent $500,000 in the second 5 years. And we put about $1.2 million in that third pile on day 1. As long as we achieve a 7% rate of return, that number will double, and we'll have about $2.5 million by the time the 10 years have passed. So again, you spent $1 million, you started with $2 million, and now you got $2.5 million, which helps you with inflation and things like that.
And then we just start the process all over again.
Exactly right. One thing I do want to point out, though, is that 7% number that I threw out there is not a guaranteed rate. However, if you look at historical stock market performance, it's well within reason for an expectation.
In fact, last week we just met with a client, and that third pile of money, we actually ran a projection of using 6%, and they actually worked out just fine. So,
once again, this is Alex and Robin.
With that said, if you have any questions in regards to what you're paying as far as your funds or your advisor, and you have any questions for us, please let us know. We're here to help. Phone number is 520-318-4600. This is Robin and Alex. We'll see you next time.